Hi there, my name is Michael, and I'm the CEO and one of the co-founders of Hummingbot, an open source software that allows people to build crypto trading bots of all kinds. A lot of our users use our software to build market making bots that provide liquidity to either a centralized or a decentralized crypto exchange. We started about 2 years ago, and today we have about 16,000 people using our software in all kinds of different ways, both professionals as well as individual users. What we started to do in the last few months, we're seeing a lot more professional users. And so from them, we've learned a lot more about the strategies they employ and how they're using Hummingbot day to day to run their businesses. We've created videos with hedge funds like 3J Capital and Binary Financial that explain how they're using Hummingbot. And we wanted to start a new video series that teaches our users kind of like some of a framework that they can employ to really trade like the pros. And so today I wanted to start to illustrate that framework and to talk about the 4 most important things that you want to do when you're market making like a professional, and then also walk you through an example of how you can do that in action. Before we get started, this demo is purely for educational purposes. This is not to try to get you to buy any particular token or trade on a particular exchange. Instead, I'm trying to teach you the theory of how professionals view market making. I want to give you some tools that you can then go forward and apply that to other types of trades that you might want to do later on. So let's get started. So when we talk to a lot of our professional market makers, they really tell us that this is their goal. Their goal is to provide liquidity while hedging market risk, and they're earning profits from the liquidity rewards provided by one or more of the venues they're trading on. So what's unique about this approach is that the market maker is not trying to kind of like defend against market risk by adjusting the parameters or tuning their bots based on changing market conditions. Instead, they are trying to set up a trade where they're not taking market risk at all, or that market risk is somehow mitigated by some other factor. And instead, they're making money from the fact that the venues that they're trading on are rewarding them for providing activity on those venues, either in the form of orders that allow other people to trade on the venue, or in the form of trades that generate transaction volume for that exchange. So this is a very different approach from how a traditional market maker would operate in the FX or the equities worlds, because those worlds are dominated by a few large trading firms, a limited number of venues that restrict access to those large firms, and it's a very mature market that isn't very volatile. And so it allows market makers to set very tight spreads and compete on the basis of speed and kind of price time priority, rather than having to deal with volatility and so on. But the crypto landscape looks really different. Crypto looks more like this, where it's an incredibly fragmented world of exchanges competing with one another, both centralized exchanges competing with decentralized exchanges, but also spot exchanges competing with perpetual exchanges. But what's unique is that this landscape is changing all the time. There are constantly new startups being created every day that are new exchanges that are competing with the established landscape. And it's that competition that is driving these venues to compete for liquidity. And so that's why they're creating incentive programs called liquidity mining programs and so forth in order to attract traders to the venue. So on one hand, you have venues that are rewarding traders for trading on their venues. But on the other hand, this kind of confluence of exchanges allows market makers to exploit the differences between them. And so it allows create trade setups where you're providing liquidity in one venue and you're hedging that risk on another venue. But by doing so, because you're trading on 2 different exchanges, you're not only mitigating the market risk associated with that, but you're also kind of like providing volume and liquidity to two different exchanges. And so in theory, both exchanges, may want to reward you for that. And so the game is really about kind of finding these trade setups where you're able to kind of minimize or hedge market risk, but you're still earning rewards. So now let me go into more detail and show you talk about the 4 factors that are important in actually setting up a trade like this. The first one is market risk. And what I mean by market risk is really the same risk that every market maker, whether you're providing liquidity on a centralized or a decentralized venue, faces. On decentralized venues like Uniswap, they call this impermanent loss. On order book exchanges, it's typically called inventory risk or volatility risk and those forth. But overall, it refers to the same concept, which is if you're providing two-way liquidity, if you're kind of providing a buy order and a sell order on the order book, you're exposed no matter which way the market goes. Let's say you have a buy order on the market and the market goes down. So now it's more likely that your buy order will be filled. So then you replace that buy order with another buy order, and then the market keeps on going down, and so you're filled again. And so you put another buy order on the market and you fill it again. And so what's happening is the market, as it goes down, as you're providing more and more liquidity, your buy orders are being filled, but at lower and lower prices. So you're essentially accumulating, you're buying more of this asset that's going down in price. Conversely, let's say the market goes up. And so likewise, you have a sell order and a buy order on the books. So now, because the market's going up, your buy order won't get filled, but your sell order does get filled. And so if you constantly replace your sell order, now you're selling more of the asset that's going up in price. And you're buying more of the asset that's going down in price. So essentially, because you're, as a market maker, you're providing liquidity to both sides of a market, regardless of which direction the market goes, up or down, you're always accumulating more of the asset that goes down in price. Let me say that again. You're always accumulating more of the asset that goes down in price, and that's what market risk is, because it's really about volatility that you don't expect. What's interesting is that is also the source of your profits as well, because if you set a spread and you're able to kind of like buy low, sell high, buy low, sell high, the fact that the market risk is also the source of your profits. However, in crypto, the volatility is so high and so unpredictable that sometimes it's impossible to set a spread that fully captures that risk, especially in the case of tokens with very low history, where it's really hard for market makers to predict whether that thing is going to go up or down 10% every time. So that's why I think hedging against market risk and finding different ways to hedge against market risk is one of the most important things in constructing these professional market making strategies. So the second is liquidity rewards. And what I'm referring to here are the fact that a lot of venues are competing with one another. So every day there are new decentralized exchanges being created. These are exchanges that are trading options, perpetual swaps, futures, and all kinds of new types of instruments. The fact that these new venues are possible allows people in the market to basically kind of capitalize on one versus another. And so a lot of these exchanges are rewarding people for trading on their exchanges, in the case of DYDX or Perpetual or some of the other exchange partners, or in the case of centralized exchanges, they're rewarding users on our miner platform, which has become one of the most popular destinations for people to reward liquidity providers. So it's basically because of these things that liquidity rewards are one of the key determinants for kind of how crypto liquidity providers should operate. And so you should take into account kind of which venues you're trading on, as well as which tokens with which you're providing liquidity. And the third factor is transaction costs. These trades are more complicated generally than normal market making bots where you're just providing liquidity in a single market. Most of the time, you're providing liquidity on one venue and you're hedging on another venue. In order to make sure you're making money, you have to take into account the transaction costs incurred on both sides, because in order to do kind of like one single trade, you might pay fees in both exchanges. You also should take into account costs in terms of round tripping your assets into the single currency or single denomination. For example, if you're market making on Binance and you're hedging it on DYDX, you still want to make sure that you're able to account for the costs of kind of getting those assets into a single denomination on a single exchange at the end of the day. And finally, the last transaction cost is time, because every bot takes some time to set up and to maintain. And so make sure you also take into account your personal time into tuning and maintaining the bot itself. And finally, the most important factor is trusted safety, because even if you find a great trade setup where you're earning like 5% every day in terms of consistent yields due to the liquidity rewards, and you're mitigating a lot of that market risk, what happens if one of the exchanges you're trading on gets hacked, or there's a bug in the smart contract if it's a decentralized exchange that causes your assets to be locked up? So those black swan events can drastically reduce your profits. And so there's almost no amount of daily yield or daily rewards that compensates for lack of trust or lack of safety in a venue. So that's why I think the most important thing when you're creating trades like this is that you understand what you're trading, you trust the venues you're trading on, and you understand what kind of tokens these are and who the issuers are. So that's why I think, to wrap up in a nutshell, here are the 4 keys to market making like the pros. Number 1, you want to minimize market risk. Number 2, you want to increase the amount of liquidity rewards you're getting. Number 3, you want to minimize transaction costs. And fourthly, and most importantly, you need to be able to trust every leg of the trade that you're creating. So, and if you're doing that, then you can kind of create these trades where you can run them consistently over the long run and continue to make money. So I want to leave you today with a small example, a trivial example, and this will be the first one we use, and I'll apply these four elements of the framework, and that's what I call for stablecoin market making. So when I say stablecoin market making, what I mean is market making a market like the one on our Miner platform, which Miner is a platform where on centralized exchanges, users of Hummingbot can run Hummingbot and provide liquidity to individual markets, like these ones right here. So here, when I say stablecoin market making, I mean a market like this one right here, for USDC to USDT on a Sendex. So this is a market where there's $250 of weekly rewards going to people who provide liquidity in this market. Currently, there's about $170,000 of liquidity in this market from 3 different bots, and those bots are going to earn a yield of 8% on a yearly basis. This example may not be the best one, but I wanted to really just to show an example of one trade that kind of fits the bill in terms of like a professional market making strategy. And as you can see from the amount of liquidity in this market, the participants truly are all professionals right now, most likely. So why is that, and why are they attracted to this market? So let's walk through those 4 factors we talked about earlier and analyze, why these professional market makers are providing liquidity to this particular pair on our Miner platform. So the 4 factors, as I mentioned earlier, are market risk, liquidity rewards, transaction costs, and then finally trusted safety. So in terms of market risk, the reason why why professionals are interested is because this is a stablecoin pair. So if we look at the volatility for this pair in terms of price over time, it's very stable. Essentially, because these 2 coins are pegged to the US dollar, this market between these 2 coins should always be around $1. And as we can see right now, in fact, in the last 7 days, this market has really fluctuated very closely around $1. And so right now, these users are kind of like tracking the bot. A really good strategy to use with Hummingbot is the pure market making strategy with the price source feature, where you're fixing the price at $1 specifically. Because in this case, I would say this is a market where you probably want to make a market around the mid price, around $1, instead of around the mid price in this pair, because it's always going to be at $1. A good strategy for this runner to mitigate market risk is simply to run Hummingbot and always make a market around $1 specifically, and ignoring kind of like what's happening in the order book itself. Because it's a stablecoin pair, the market risk is very low, and that's why professionals are interested in this pair. In terms of liquidity rewards, so a good way to analyze it is in terms of the yield provided by that pair. So if you look at this pair right now it's providing people who provide liquidity to it 0.2% daily yields, and which corresponds into 8% on an annual basis. However, there are other markets here where some of our highest yielding markets, where liquidity providers are earning much higher yields for providing liquidity into other markets. And so these markets, the yield is really a reflection of kind of like how much risk the market maker is taking when they're providing liquidity to this market. Whereas this stablecoin pair, these yields are very low because the users are not taking a lot of risk by providing liquidity to the stablecoin pair. However, 8% annualized is still a lot higher than where a professional market maker can earn, in a risk-free way. Typical yields at a bank, for instance, are in fiat are less than 1%. So earning 8% on an annualized basis is actually still pretty attractive for many people. So we've covered market risk, we've covered liquidity rewards, but transaction costs is also an important consideration. Here in this market, the maximum spread that market makers can apply and still earn rewards is 0.2%. And so that means that a Sendex typical fees are 0.1%. So that means that if you try to earn liquidity rewards in this market as an individual trader and you're paying kind of full fees, you'll be losing money due to transaction costs, because you're only earning rewards if you set spreads lower than 0.2. But if you're paying 0.1% on every trade, then you're essentially losing money by market making. And so market making in this pair only makes sense if you are a professional market maker who has a VIP level on a Sendex that allows you to pay very low fees, or if you're a Hummingbot user that took advantage of our promotion earlier this year, they gave you 0 maker fees on a Sendex by signing up at a certain time. So that's why transaction costs are a really important thing to analyze. You want to make sure you're not paying higher fees than the amount of rewards you're earning from providing liquidity. And so the fourth thing you should analyze is trust and safety, right? So, and what I mean by that is, do you trust USDC as a token? Because you'll be holding on to it. Do you trust Tether as a token? Because you'll be owning that as well. And finally, do you trust a Sendex? Because you are essentially giving up your crypto to a Sendex and trading there. So you're exposed to any Sendex related risks. And finally, you're earning rewards on the miner platform. So do you trust that the miner platform will pay you the rewards it promises at the end of the week? Now, since we run the miner platform, I think it is a trustworthy platform in my opinion. And a Sendex, we only offer miner on 4 different exchanges. A Sendex with a 3rd exchange because we view them as an up-and-coming exchange partner. And they also recently announced a $50 million Series B round led by Polychain Capital, one of the top VC funds in crypto. So I think at least from that perspective, it seems like there is some strong validation for Sendex in the crypto industry. Ultimately, every trader has to make their own determination. Do you trust the venues you're trading on and the assets that you own? In a nutshell, the reason why you have these professional market makers participating in this USDC market in Binance or Sendex is that essentially based on those four factors, those four factors are attractive on that basis. In other words, they're taking very low market risk because this is a stablecoin pair. They're earning liquidity rewards on the miner platform for providing liquidity in addition to just the spread itself. If they have a high VIP level on Binance, they can set spreads within this range and still make money. And finally, these market makers believe in the miner platform and Ascendex as a trustworthy venue. So, those are the four features. And in future videos, I'll create more examples of different trades that you can put on. The stablecoin market making example was probably the simplest way that you can kind of like trade like the pros. But obviously, you need to have a very low fee base, so that might not be available to you. So there are other ways as well. So in future videos, I'll walk you through other market making strategies you can employ that take advantage of these factors to basically hedge your risk and still earn rewards from those venues at the same time. So if you want to follow along, you can subscribe down below or join Hummingbot and our community on Discord and other places where it operates. Thank you very much. Bye.